The prominence of passive investments as in ETFs have grown to such a degree they're truly pervasive. There's an ETF for everything. More investors are choosing ETFs instead of mutual funds, instead of single stocks. They just want exposure to a particular index, and this makes it extremely easy. The problem is that, as the creator of these passive investment vehicles, Jack Bogle, said, there's a real danger in such a concentration of stocks. We have seen a narrowing band of stocks, ones with trillion-dollar valuations, favorite names in the list, and now with stocks like GameStop suddenly priced significantly higher in a matter of days, there's a rush to the exits. There's concern, and there's an exposure of a fundamental flaw in the model. Keep your eyes closely peeled because this could get ugly. You came here for the truth, so let me unveil that for you. That was a big intro, but I really wanted to set this one up because what we have today could be some interesting dynamics that unfold. This isn't just a few little simple things that are taking place. We're actually going into the underbelly of the financial system and exposing the rot. That's really what's happening here, because you can see as we have so many different avenues, so many different aspects. It's not just you as an individual buying stocks on the market and that's it. There are so many different things that are happening here. And as we found out during the financial crisis, there's so much counterparty risk that, hey, when everything's good, when the markets are running smoothly, you don't have to worry. Everything is going to be okay. But when there's a problem, when there's a disruption, that's when we start to find out about all the problems underneath. So let's talk about GameStop. Let's talk about the issues that are present going on right now. And I want to bring up some of those risks that we could be seeing. I wanted to start by taking a look at this because it really highlights the problem that we have. GameStop drama hammers retail ETF as nearly 80% of assets exit. XRT has posted nearly $700 million in outflows this week. Theories include a desire to obtain underlying GameStop shares. This could absolutely be the reason. I've seen that specifically, people calling for that, but we don't know exactly. But the point here is that you've got an issue with ETFs that's fundamental in it because you've got a concentration here that has changed in a rapid period of time. I'm going to give you the charts on that in a second here, but this is just one very, very specific example that's going on today. As the GameStop saga continues to play out in the markets, the drama has now cost what was an $800 million ETF nearly 80% of its assets. Investors have pulled roughly $700 million from XRT this week, draining total assets to $164 million. The outflows come after GameStop's surge swelled in its weighting in XRT to 20%. Given that the fund tracks an equal weighted index, the video game retailer weighting should be closer to 1%. So we're going excessively high, and it was just a short period of time. I'll give you the charts, but look at what they have to say here. Theories abound as to what motivated the outflows, given that they happen alongside a nearly 20% rally in XRT this week alone. One possibility is that XRT redemptions are delivered in kind, meaning that its shares are exchanged for the underlying stocks in the fund. Investors are ditching the ETF to get their hands on the hard-to-borrow GameStop shares. As I mentioned just a moment ago, this is something that many of those in the Wall Street bets and so on have talked about. They want those actual shares. They don't want the ETFs. They don't want what Robinhood has to offer because you're not getting in the actual shares. You want those, and that's what they're doing here. And I really think that that's part of it, sticking it to the hedge funds. But you let me know in the comments and what you think is really going on. Rush to the exit. Total assets in XRT plummet amid GameStop drama. And you can see on the right-hand side there, just absolutely destroyed over this period, while through 2020, it was basically moving higher and higher and higher. And then suddenly everything fell out. This is the chart, the actual price itself, and you could see what had been happening over this period. That's a different scenario though than the actual assets, because you look at the two and right now they're at complete odds. These were the top holdings in the fund. Looking at it on the 31st of December 2020, the second last one there, that's GameStop, 1.58%. Fast forward, you're looking at GameStop at its peak was at 20%. 20%, a big change, no doubt. Look at what's been happening right here. I'm going to give you several charts. First one, the most shorted stocks have rallied sharply. And you could see that over this period, just in 2020 through 2021, there's been some serious volatility. And you're just looking at the most short basket rolling 3-month return. And that right now, plus 98%. This goes a lot further when you look at the particular basket, what it makes up of. Of course, all the names that you're seeing now today are part of that, but there are some others that we had talked about previously, like throughout 2020 with Tesla. There's just some serious change that's happening right now. And if you look at this one, it just shows you the most shorted stocks basket has been rising significantly over the past several days when you look at all of that retail interest, but also when the retail traders are going in, you're getting a lot of, let's say, Citadel and the others that are moving their money based on what the retail traders are doing. You know that specifically that those high frequency traders are betting on what's happening based on the retail. They're just using them as a guinea pig and they're being pulled in the same direction. So I don't know how quickly this can turn around, certainly, but we have an issue in that you need a consistent amount of new buyers going in, because I've been noting that there's been a lot of funds that have been selling off their shares because, hey, they're seeing the profit there and they don't need to hold on a lot of these funds. There's necessarily no reason why they wouldn't sell. If they believe that the price is going to go down further, they'll sell off right here, take that profit and invest in something else. They'll move their money around. So you're going to definitely need more retail traders to move in. They'll need to hold their positions. So we'll see what happens. Despite active degrossing this week, fund leverage remains elevated. This is aggregated data from Goldman Sachs, and you could see that's brand new info. And I just wanted to note the fact that there's so much exposure when you look at what's been happening. At the bottom there, just notes Goldman Sachs Prime Services hedge fund leverage. Of course, all the way up as high as you can get this. Historically, we're going into a state in which everybody believes the market's going to go higher. Now, not necessarily particular stocks. You might think that this one stock or that one stock is too elevated, that will come down a bit, that will, sort of retrace where its parameters are today. I don't know all the specifics, but what I can tell you is that there is no money sitting on the sidelines despite that theory, and you're looking at some serious exposure, not just from Goldman Sachs, but of course you pull all that data from every corner of the world, and you are seeing that there's so much in equities today, more than ever before. Before I cover a couple quick things here, I just wanted to note this. We are talking about something that could be much bigger than GameStop, much bigger than AMC and COS and all these companies that perhaps you thought were going the way of the dodo bird. But look at the SLV short interest. That has been rising here, and now Wall Street Bets has started to discuss what could be the mother of all. We're looking at some serious plays right now, and they believe that this is going to be the next one. I don't know. I'm not going to speculate too much, but I certainly know that this has been the most manipulated asset in my experience and what I have seen. Precious metals in general, but definitely silver. So we'll see if they can actually do this and maybe send the price up higher. I want to know what you think of this. Of course, let me know in the comments. A Reddit army descends on hedge funds chained by risk models. Risk models seen fueling fund deleveraging in short squeeze. Volatility also jumped as stock market correlations broke down. So there are some real problems that are taking place today for these particular funds because everything is getting skewed by what's happening in these group of stocks. But just why have the institutional pros forced to downsize their market exposures at the fastest pace since March? Well, one reason is that their risk models told them to. As a flood of retail money sent stocks like GameStop and AMC surging, the trading signals that guide how the smart money invest flashed red, known as value at risk. This crude but widely used metric showed just how vulnerable the equity long-short crowd was to losses based on historic price moves. So remember that it's not just emotion. It's not just going here with one avenue and one decision and everybody goes in like what the Wall Street Bets type investor is doing right now. A lot of these are based on models and formulas and complex derivatives and things that most people can't really understand. You've got PhDs back there that are doing things that shouldn't even be in existence because of how dangerous they really are. But the point is that we could see some major changes taking place just based on this fact alone. So I'm keeping an eye on it as well. I thought this was interesting and we'll see how it unfolds, but Canada's answer to Robinhood is basically called Wealth Simple. Same kind of thing, except it's for Canadian users, warns traders but won't halt stocks. So they basically put a warning label when you go to buy things like GameStop, but they're allowing you to actually purchase it. They're not limiting the amount of shares. They're not doing what Robinhood is doing, at least for now at this point. But they are just kind of suggesting to people. So there might be these different brokerages out there who allow it, and they might see some of those trades taking place on their platform, people leaving certain platforms to go to other ones. I know there's going to be a void to fill because a lot of people have discussed leaving Robinhood. So we'll seriously have to pay attention to that because there could be a lot of money moving around. But one thing is for certain, and that is the Federal Reserve will not pull the printing press. They will not increase interest rates. They will not slow down whatsoever. The Fed president, I believe it's San Francisco Fed president, pushes back against pulling policy aid to curb stocks, basically saying we are doing what we're doing because we want to help people. We want to help the average person. So we're going to print money and give it to Apple. I mean, it is an absolute joke, but this is what we're dealing with. I just want to note this here because it just shows you that underlying all of this, we see the banks, we see the hedge funds, we see the Reddit traders, Robinhood, and so on. You look at what's been happening all along and how these interconnect, but nobody is looking over here at the Federal Reserve. It's like they're an arsonist with a match in their hand and you wonder what they're doing, but everybody's all focused what's going on over here, not really looking at the very, very obvious fact going on with the Federal Reserve. But anyway, that's what we're dealing with right now. That's all for this video. If you found that informative, hit that thumbs up button. When you do, you support me. Thank you very much. If you want to learn about e-commerce, you can do so for free, the AmazonGPS.com. If you want to learn about the financial system, central banks, interest rates, all that business is in these two books. So easy to learn from these. Check them out at the link in the description. And if you haven't seen this video, you have to check it out. Lots of detail talking about this issue, expanding on it. Click it. I'll see you there.